Imagine two buyers walking into the exact same dealership in the exact same month to buy the exact same vehicle. One buyer finances the car, and the other pays pure cold cash. Now, conventional wisdom tells us that cash is king, right? The cash buyer should absolutely get the better deal. Well, welcome to Dollar Playbook, everyone. I'm Taylor Reed. Today, we are diving into an explainer that cracks wide open the ultimate car buying mystery. We're going to look at the actual financial data that proves the exact opposite of what we've all been taught, and we'll uncover exactly why a cash buyer actually walked away paying significantly more for the exact same vehicle. To really understand this, let me tell you a quick story about two neighbors, Derek and Travis. So, Derek had been planning his new car purchase for months. He did all his research, went into the local dealership, and after some pretty tough, drawn-out negotiations, he financed his car and drove home feeling victorious. Now, his neighbor Travis saw the shiny new car in Derek's driveway, absolutely loved it, and went to the exact same dealership the very next weekend for the exact same model. Travis proudly paid cash, assuming it gave him the ultimate leverage. But here's the wild part. He walked away paying $2,400 more than Derek. Same car, same dealership. So what in the world happened? Section 1. The cash versus financing trap. Okay, let's dig into this by first examining Derek's strategy. Because to figure out why Travis paid so much more, we really have to understand the visible layers of dealership pricing versus the invisible layers that most consumers literally never see. So Derek really did his homework. He looked up the manufacturer's invoice price, which is supposedly the price the manufacturer charges the dealership for the car. For the specific model he wanted, that invoice price was $29,900. Derek went in, negotiated incredibly hard for over an hour, and got his final price down to just $50 above that invoice number. And then he gets the classic line. The salesperson leaned back, sighed, and told Derek, "We are basically losing money on this deal." You know, that single sentence made Derek feel like he had totally beaten the system. He thought the dealership only made a $50 profit on him. But here is the absolutely crucial point to remember. That visible $50 margin is just the tip of a massive 14-layer profit iceberg. It is the only layer you are actually allowed to see. Section 2. The hidden profit layers. Let's move below the surface and take a look at the secret front-end financial arrangements that happen directly between car manufacturers and dealerships. These are payments that will never, ever appear on consumer pricing websites. The very first hidden layer is what's called a dealer holdback. Simply put, this is a hidden refund that the manufacturer sends back to the dealership after a sale is completed. It's usually about 2 to 3% of the total sticker price. So on Derek's car, a simple 2% holdback quietly handed the dealership over $600 entirely behind the scenes long after the paperwork was signed. Derek thought they made $50? Well, the holdback alone paid them 12 times that amount. But you know, the holdback is really just the beginning of the story. There are several other invisible subsidies going on. Manufacturers offer dealer cash to dealerships to push overproduced models off the lot. Then you have volume bonuses, which pay dealerships massive payouts for hitting specific sales targets, and this is exactly why dealerships are always so much more flexible at the end of the month. Manufacturers also offer regional rebates strictly for dealers, floor plan assistance to cover the interest on the dealership's own inventory loans, and even payouts based on customer satisfaction scores. Collectively, these hidden incentives drop the dealership's true cost far below that manufacturer's invoice price you were looking at online.
Section 3. The most profitable room. Now, what's absolutely fascinating here is that even with all those hidden front-end incentives, the real wealth is not actually generated on the sales floor. It's generated in a small room you visit after you think the negotiation is completely over.
So where exactly does the dealership make its absolute biggest margins? It's a really common misconception that the friendly salesperson out on the lot is making all the money. In reality, the highest earning salesperson in the entire building is the finance manager. They're sitting quietly behind a desk, just waiting for you to walk in with your guard down. Let's actually look at the public financial data from large dealership corporations to see the exact profit margins on what they call finance and insurance, or F&I products. Take a look at the loan reserve. This is simply a hidden markup on your approved interest rate. If the bank approves you at 4%, the dealership might quietly charge you 5%, keeping that difference as pure profit, which averages $600 to $800 per car. Then you have extended warranties generating $700 to $1,000 in margin, gap insurance bringing in $250 to $400, and small protection add-ons like floor mats or paint coatings bringing in up to $300. And this perfectly illustrates how this profit machine doesn't just stop with the add-on products. It extends right into the paperwork itself.
Seemingly routine administrative tasks are structured to generate massive returns. Processing and documentation fees are pure profit centers, making $400 to $650. E-filing, the temporary tag you stick on your dashboard, and even the digital notary fee are all marked up. When you combine these so-called routine fees, they generate another $700 to $800 in pure profit per vehicle.
So when you add up all those finance products and paperwork fees, the finance manager's office makes between $2,700 and $2,900 per car. Think about that for a second. Derek negotiated a great price on the surface, but he unwittingly gave back nearly $3,000 in the back room. The dealership ended up making massive margins on a deal they claimed was quote-unquote losing money.
Section 4. Why cash costs you more? All right, let's pivot back to our cash buyer, Travis, because we now have the context we need to solve the mystery of why his total cost ended up being $2,400 higher than Derek's. Travis walked right into that dealership and confidently dropped 5 words: "I am paying cash, best price." He assumed that cash is king. He really thought that bringing guaranteed upfront money to the table would secure him the ultimate leverage, remove all the dealership games, and result in a straightforward transaction with a steep discount. But here's the totally counterintuitive truth about the modern auto industry. Declaring cash instantly deletes the dealership's most valuable revenue stream. You see, to a modern dealership, the car is just the vehicle for the actual product, which is the auto loan itself. By paying cash, Travis eliminated the loan reserve, the gap insurance, and the extended warranty upsells entirely. With the whole back-end profit layer just vanished into thin air, the dealer was essentially forced to hold firm on the sticker price just to make their money. By trying to be a strong cash buyer, Travis actually destroyed his own negotiating power. Now, you might be thinking, well, I just won't tell them I'm paying cash until the very end, right? Well, dealerships know this trick, which is exactly why they have hidden financing tests built right into the process. First, there's the intake clipboard at the front desk asking how you plan to play. Second, you hit the routine credit check halfway through, which, by the way, isn't actually about your creditworthiness at all. It's a test to confirm you still intend to finance. And finally, there's the loan application filled out before you even enter the finance room. Hiding your cash status gets harder and harder, and as you deflect these steps, your negotiating leverage shrinks at each stage. Section 5. The winning buying strategy. So how exactly do we navigate all of this? Let's transition into the practical, actionable lesson of this explainer, so you can actually use the dealership's own profit machine against them to get the absolute best deal. Here is a precise 6-step game plan to maintain your leverage. Step 1. Walk in as a financing buyer. Never mention cash. This keeps you classified as a highly profitable customer in their eyes. Step 2. At the clipboard stage, ask upfront about loan origination fees to confirm they do not charge any. Step 3. Negotiate the purchase price aggressively. They are going to be very flexible here because they fully expect to make it all back on the loan. Step 4, when you finally get to the back room, negotiate all those F&I products because you now know exactly what their true profit margins are. Step 5, and this is absolutely vital, check the loan contract incredibly carefully to confirm there are 0 prepayment penalties. Finally, Step 6, sign the paperwork, drive your beautiful new car home, and pay off the loan the very next day or week before any interest accrues. You get the financing price, you avoid the cash penalty, and you completely skip the interest. Financial leverage really comes from understanding exactly how the other side makes their money. Now that you've seen the 14 layers of the profit machine, are you ready to turn the tables the next time you step onto a lot? I truly hope this explainer brought you some real clarity today. If you found this breakdown helpful and want to keep building a stable, financially smart life, please like this explainer, share it with a friend who might be car shopping soon, and subscribe to Dollar Playbook for more practical financial lessons. I'm Taylor Reed. Thanks so much for joining us, everyone, and I'll see you next time.